Welcome back, you legends. I'm Dr. Cal, and in this weekly update video, I'm going to blast through just a handful of key weekly charts, so let's jump right into it. This is the weekly stock market map, and it's kind of split. If you notice, legends, we have this red corner. The rest of the market is a mix of red and green. Tesla did amazingly well this week. It broke out of a key bull flag that I discussed in the trading community. Banks did surprisingly well, and small financial services companies also did well. Utilities, kind of the star of this week, honestly. They did some of the best performance this week. Taking a look at the weekly performance, legends, again, look at this: utilities up 2.9%, followed by financials, basic materials, consumer cyclicals led by Tesla, and the worst performing is tech. And in fact, we talked about a key chart in the last video where tech is testing a key support line. This key support line that goes all the way back to the October bottom. We've tested it several times now. Take a look at this, legends. This was the August 18th bottom, tagged it perfectly. Then we had a double bottom, August 25th, tagged again, formed a higher low this time. And last Friday, we came very close to tagging it. Remember, legends, these support lines, these trend lines are kind of like trees. The more you hack at them, they will eventually collapse. And when a trend line like this breaks, we immediately go to the next level. The next level, legends, is a ways off. Look at this, down all the way at 331, this prior swing high from August of last year. If we break the support line, there's nothing really between current levels and 330. We have this prior swing high, and we have an ascending 200-day moving average. Very often, legends, after a huge bottom forms like the October bottom last year, we get a breakout. That breakout ends up fizzling out, comes back to test the 200, and then we continue higher. And so far, we did not come anywhere close to tagging the 200-day, and the market is now entering the worst time of the year for tech stocks specifically. That is the second half of September, going all the way into the end of October. Now, the second half of September, legends, tend to be pretty bearish. The blue line is the NASDAQ. The NASDAQ tends to top on the 13th trading day of September. That's September 21st, so next week. And we tend to take out all the prior lows in September after that high is made. Looking further out into October, this is the S&P 500. And again, legends, look at this. We tend to get a bottom at the end of September, a rally to start October, then continued selling down. Sometimes we make a lower low versus the August low. That's the seasonality for all pre-election years. In pre-election years, after a midterm bear market, just like last year's midterm bear market, we actually tend to make an equal low to the end of September in October and a higher low versus the August low. So we'll see which one we'll get. Now, this purple line is the S&P 500 so far in 2023. And if you notice, legends, it is staggered to the right. It is shifted to the right. And I'll show you specifically where that shift is very obvious. Here, legends, look at this. These highs in July, usually seasonally speaking, they come between early to mid-July. This time around, they were staggered by 2 weeks. The bottom in August usually comes in early August. It was staggered by 2 weeks. If we assume this staggering formation continues, when should we expect a bottom? Well, we should actually expect a bottom in mid-October and in early November, not late September and late October, okay? Generally speaking, September, October tend to be weak to flat months. In fact, between August to the end of October, it tends to be seasonally the most bearish time of the year in all pre-election years. Now let's jump to the daily chart on the S&P 500. If you want a more granular look at the daily stock market analysis, check out my last video. In this video, I'm going to focus on the weekly chart instead. And I want to do some volume spread analysis. Volume spread analysis, legends, looks at the volume and compares it to the size, the shape, and the color of the candlestick. And I'll explain exactly what I'm talking about. When you see big candles, whether those are red or green, you want to see volume that's in line with both the shape of the candle, the size, and the color. So big green candles, we want to see big green volume. Big red candles, we want to see big red volume. What happens if we get the opposite? Let me show you what happened in August of last year. We had this very sizable green candle. The volume bar was actually lower than all of the other volume bars. This is a bearish volume spread divergence where you had big green candle not validated by the volume. And the higher we went, the more the volume declined, meaning higher we went along, the less and less conviction we saw in the price. Now, we saw exactly the opposite with these red bars, right? We saw volume going up. We saw the size of the candles going up. Now, this is confirmation that the bearishness is real. And again, look at this other green bar, larger than the prior red bar, volume significantly lower, meaning bearish volume spread divergence. And it led to more lows. Okay, so what do we have more recently? Let's take a look at these candles. This candle is actually pretty much equal in size to the prior candle. However, volume is larger, significantly larger, and we closed below the last week's lows. So we have more conviction to the downside in the short term on this candle versus the prior candles. Now, this does not necessarily mean that we'll get a crash or anything like that. It just means that there's a high likelihood, a higher than normal likelihood that these weekly lows will be taken out. So maybe we'll go slightly lower yet again and tag the lower edge of this support line. And at that point, we will assess again what the volume looks like and what the candle looks like. And yet again, legends, look at this massive green candle, lower volume than the prior candle. Even though the prior candle was significantly smaller, this is again bearish volume spread divergence. I hope that makes sense, legends. So far, what we're seeing is that green volume is lower than the red volume. Large green bars on the weekly chart are not getting validation from the volume, whilst red bars are getting validation from the volume. This means that we're still in a highly risky environment. Sentiment is still indecisive, and buyers are not showing commitment. They're not following up. On the hourly chart, legends, we do have a stochastic that has crossed down. It is moving down. It is getting closer to oversold territory. In oversold territory, we expect buyers to step in at those levels. We're not there yet, but this opens the door for a potential bounce to start the week next week. Either we gap down and rally, or potentially we open higher, then continue lower. Either one of these is possible. And the way to trade it is pretty straightforward. If we gap down, you might want to catch the rally to fill the gap at 443. If we open higher and gap higher at 445, you might want to sell that gap higher to a gap fill lower, or potentially even lower to 440. Let's take a look at the BPSPX. The bullish percent index for the S&P 500 is down below. The S&P 500 is up above. Huge volume bar today. Quad witching was last Friday. Quad witching is when options expire for the indices, individual stocks, futures contracts roll over as well. So we get a lot of institutional rebalancing, and the volume last week was in line with that. We had 5 times the institutional volume relative to retail. So all of this selling was big money selling. It's very disconcerting what the institutions did. This is the volume on the 13th of September when we got that little dip just one day ahead of the short squeeze Thursday and 2 days ahead of the dump Friday. Well, all of these are institutions buying. Look at the volume. Enormous volume. Whereas retail, this is retail. Fifth, look at this. Kind of nuts what happened. So they faked a rally Thursday, and it was clearly a defensive rally. If you watched my video, they bought up utilities, they bought up energy, they bought up basic materials and real estate. So that was a defensive inflation hedge trade, and tech was lagging. When tech is the worst performing out of the bunch, you know that it's a defensive rotation. And just like that, they pulled the plug on Friday. On the BPSPX weekly chart, we're still above the key 38.4 level. Look at this. Came extremely close to hitting that level, not there yet. This is a level that I personally identified as a key trend marking level. Whenever we're below it, the market gets additional weakness. All of these are clear examples of what happens when we dip below 38.4. All of these are examples of additional weakness coming in when the BPSPX dips below 38.4. The only exception was this candle, and that was a clear exception because I discussed this. This was a volatility contraction pattern that I discussed, one of the absolute rarest patterns and one of the most explosive bullish patterns. With that exception out of the way, again, we dipped below 38.4, got additional weakness. Recently, we came down to 38.4, but bounced right above it. As of the close of last week, we're still above it. If we dip down below it again, very likely, legends, we take out these prior lows. So if we close next week below 38.4, we're almost certainly going to take out these lows. If we close above it, we're likely to form another higher low and continue higher. More key data from the BPSPX is this chart. Up top is the S&P 500. This is the BPSPX. We formed a low and a lower low. And on the BPSPX RSI, we formed a low and a higher low. So this is a bullish divergence between the BPSPX read, the actual reading, and the momentum behind the BPSPX, the bullish percent index for the S&P 500. Now, quite often, legends, when we get these double bottoms, either with a higher low or a lower low, we usually form a bottom and we continue higher. So this second bottom could extend lower and we would still establish a higher low. We would still establish a bullish divergence. So even though the picture, legends, is looking more and more bearish, there is a light at the end of this tunnel, as these double bottoms always correspond with major bottoms in the stock market. Without exception, they always correspond with major bottoms in the stock market, okay? So we are in an extremely vulnerable time of the year in the stock market. However, it is the perfect time to look at discounts, deals in the market, buying overlooked companies that are trading significantly below their historical PE ratios. They're still growing, they're still doing well, but they're completely ignored. One of those companies obviously is PayPal. I have a bunch of these companies that I discuss. Some of them are Chinese companies. The Chinese economy as a whole is showing signs of a huge bottom. The technicals are also showing those signs. I discuss all of these setups in the trading community. If you're interested, you can join. It comes out to about $35 a month if you go for the annual membership. So it's a single payment once a year, but it comes out to roughly equivalent to $35 per month. That's where I share all of my trades, my investments in real time, and all of my trading setups and my daily live analysis. The point being, legends, whenever you see the BPSPX oversold to this degree, you have to go shopping. You absolutely have to go shopping with the medium and longer term in mind. Not necessarily a time to short the market, even though it is seasonally bearish. It's actually the best time to look for deals in the market when seasonality is bearish. Remember, you don't want to be selling when the market is weak. September, October, you want to be accumulating, buying high quality names, high quality setups, and then selling in the euphoria that usually comes after the holiday season to end December. That's when you want to book those profits. So don't let the big money scare you out of the market. Just sharpen up your trading. If you're trading, tighten up your stop losses. Do all of that stuff if you're trading short term. If you're investing, if you're trading longer term, doing 6 months plus out swings, you have to go and shop for good deals. Another chart that I want to discuss is the Cohen High-Low Index for the NASDAQ. Now, the Cohen High-Low Index triggers buy signals whenever it is below the 0.05 reading. We're not there yet, but it's quite often a powerful buy signal to look at in the short term, in the medium term. It's something that we have to look at. It marked significant bottoms in bull markets, and it did well at marking medium-term bottoms in a bear market. So what is it doing now? It's at 0.25. You want to see this go lower. And very likely, legends, if the NASDAQ does break this key trend line, continues lower, goes down to 330, tags the 200-day moving average, does all of that within the span of the 6-week bearish season that ends at the end of October. That'll be the perfect time to buy the dip. And we can use tools like the Cohen High Low Index to corroborate that bottom. So far, not there yet, so I would actually be staying away from big cap tech. We're also beginning to see double bottoms on key charts like the S&P 500 200-day breadth and the S&P 500 50-day breadth. Now, if we go back and look at all the times before where breadth came this low to 32, formed a double bottom, what happened next? Well, in this example, that was the bottom. The market rallied higher. This example, it came below 32. It went all the way to 15. This is the 50-day moving average, so these extreme readings are more common. We also got a bottom rally, double bottom, also got a bottom, and the market rallied. Even in bear markets, legends, when we got this low, we got bottoms and the market rallied without exception. Every single time we went this low, the market bottomed and we had a rally. In the 2021 raging bull market, when we got that low, that was again the bottom, the market rallied. Again, look at this, even in the significant sell-offs in September and in October, we got key bottoms and the market rallied. So far, we are still in that same level. Let me use the horizontal line tool. Whenever we're below this line, the market is actually forming a kind of a bottom. Sometimes it takes a while. For example, the September to October period in 2020, we got a bottom, then had a rally, significant sell-off again, another bottom and a rally. So even if we get a significant sell-off to end October, for example, so 6 weeks out, that would still be a time to go shopping in the market. What about the 200? The 200 is above this critical 44 reading. I marked this reading because whenever we dip below it and recover it, stay above it, that often marks the beginning of a significant uptrend. We got that sign, we got the confirmation after we formed the March bottom. That was the sign to begin looking at more and more long trades. The 200-day breadth still looks a lot more bullish than the 50-day breadth. We're tagging a significant support line. Even if we break it, even if we go lower, we're still likely forming a significant bottom. Notice, legends, whenever the histogram goes from green to red back to green, we nearly always confirm that a bottom has already formed. It confirmed the August bottom. Odds are we could still go back to form another key bottom in October. That is actually in line with seasonality. September, we tend to get a lower low at the end of September. And in October, we tend to get another bottom. Some years it's a lower low, some years it's a higher low. Either case, more often than not, the second half of October is when you want to be buying. The end of September is also when you want to be buying. So we will be looking at additional weakness coming in next week, and then potentially a bottom forming the week after that for a rally to start October. Sell at the end of the first week of October. Wait again, wait for that bottom at the second half of October. Ride that again to the end of the year. Other charts that I want to discuss is the AAII Bull Bear Survey. If you notice, legends, the Bull Bear Survey is turning more bearish. Look at this. It is turning more bearish, less bullish. That's a good sign. If you are a bull, you want to see more folks turn bearish to buy. When you see more folks turn bullish, that's when you want to start taking profits. The spread between the bulls and the bears is continuing to expand. It is forming higher lows and is continuing to expand. Even if we get a double bottom, again, legends, more likely than not, we're establishing a key bottom the next 6 weeks. That's 2 key bottoms, one at the end of September and one in the middle to end of October. We want to focus on identifying the most high quality setups to accumulate those end of September, end of October, and ride all of those to the end of the year to cash in on the holiday season rally. What about the fear and greed index? Let's take a look at the timeline, still making higher lows here. And if I actually draw a trend line, we could still tag that trend line within October and we would still establish higher lows. So again, I love this seasonally bearish time of the year because this is when you're going to get all of those great deals. Okay, what about market momentum? Still showing greed, still above the 125-day moving average. I would not be surprised at all if we tag it by the end of October. Stock price strength flattening, trying to turn back up. So we could see some attempted rallies to start the week next week. If we get a dovish Fed, and if the Fed actually hints at the end of the rate hiking cycle, I expect a nice rally next week. If the Fed does not hint at anything, kicks the can down the road to November, I expect the market to continue to be vulnerable. If the Fed actually hints at a rate hike, I expect the market to continue to sell off next week and the week after to end September. Stock price breadth, we're beginning to form this beautiful double bottom. So again, legends, even though seasonally this is a bearish time of the year, we can get a lot of chop. The key is identifying those high quality setups, your favorite stocks. Look at your favorite stocks. Are they overbought, oversold? Wait for that bullish setup to complete. Look for double bottoms, look for bullish divergences, all of that good stuff. Put them on your watch list. What about the put to call ratio? It is forming a triple top formation, potentially a bull flag. Not quite obvious yet, but more so than not, it is looking like a triple top. VIX still below the 50-day moving average. Whenever we're above the 50-day moving average, the market is selling off. Whenever we're below the 50-day moving average, the market is actually rallying. So far, we're still below the 50-day moving average. Bond demand still very high. In fact, high yield bonds, the smart money is up top, S&P 500, dumb money down below. We formed a higher low Friday, so the smart money is still buying the market while the S&P formed a lower low. This divergence is a bullish divergence. Divergent lows are bullish divergences. Divergent highs like these are bearish divergences, okay? Bearish divergences. Divergent lows are bullish divergences. What about the Dow Jones Transports and the Dow Jones Industrials? Again, we're forming divergent lows, higher lows on the industrials, lower lows on the transports. They are beginning to form what looks like a bull flag. So even though seasonally this is a bad time of year, we're still seeing signs of bullishness in specific parts of the market. Not tech in general, but specific parts of the market. Things like staples, utilities, small caps like the Russell. These are beginning to pick up steam. Speaking of the VIX, let's talk about the VIX. The VIX formed this bullish engulfing candle on Friday. The last time we had a bullish engulfing candle like this was the market top, and we ended up getting two counter trend rallies before the market continued lower. So are we going to see the same? This is the S&P 500 down below, legends. So are we going to see two counter trend rallies Monday and Tuesday and then get the sell-off at the Fed meeting Wednesday? That's possible. If the pattern repeats, that's what we're going to get. The CPC put to call ratio buy and sell signal went above 1.1, came back down. We're still waiting for the PPO to produce a buy signal. Not there yet. Getting closer every day. The histogram is declining whenever it goes from green to red. After the signal drops from 1.1 to below 1.1, that triggers a buy signal. Not there yet. We're still waiting for that buy signal. But again, this continues to look like a triple top on the CPC put to call ratio. The put to call ratio, legend, is pretty simple. It measures the difference between put buying and call buying. Whenever put buying slows relative to call buying, it indicates that bearishness is coming out of the market and institutions are rotating away from selling the market to slowly buying the market. And we saw that happen in spectacular form as the market formed that key January bottom. We got another triple top here as the market formed the March bottom. And we continued to move lower. And then we began to see the ratio rising ahead of the market topping. So we want to see this ratio declining ahead of the market bottoming. Economic events next week, Monday, Tuesday, not much going on. Wednesday, we have the Fed interest rate decision and press conference. And to end the month on September the 29th, we have the PCE, the preferred inflation measure by the Fed. Seasonally speaking, we're entering a very vulnerable time of the year. We Seasonally speaking, we expect a top around September 20 to September 21st. That's if we follow this typical September seasonality. We usually get a top on the 13th trading day of September. 13th trading day is September 21st. After that, we tend to get a low at the end of September, early October. We get a bounce, and that bounce fizzles away, and we get another key bottom in the second half of October. That tends to be the last time to pick up stocks for cheap before the market begins to rally in earnest in November and in December. So to summarize, legends, BPSPX showing a double bottom. A potential bottom is forming in September. Likely at the last week of September, we will have already formed a bottom for a rally to begin October, then another sell-off, then another sell-off in October for something that looks kind of like this, right? Kind of like this as well. If you want to buy tech, watch the Cohen high-low index. I'll update you, legends, whenever we get below 0.5. That's when you want to actually buy lots and lots of tech. Not there yet, but we're getting closer with this double top. We'll likely move back down to 0.5 by the end of October. S&P 500 200-day breadth is showing a double bottom. The 50-day breadth is also showing a double bottom. So even though, seasonally speaking, we're still in a very, very choppy and vulnerable time of year. In fact, the NYSE Summation Index shows this fact. Look at this, legends, whenever we get a lot of whipsaw signals, when the Summation Index moves sideways, we often get periods of chop that end in a key bottom, right? Periods of chop that end in a key bottom. So expect more chop in the next 6 weeks. Put to call ratio is showing signs of slowing down, major signs of slowing down. The last time we had a triple top like this, the market was actually forming a huge double bottom. Short term, we're looking at this support line to get tagged on the weekly chart and on the daily chart. That key level is 440 right here, and we expect to see a continuation of this contraction pattern. This contraction pattern will eventually get a breakdown or a breakout. Look for a break below the support line for a breakdown in continuation to 431. Look for a close above resistance for a continuation to 460. Short term, in the next 6 weeks, the market continues to look very vulnerable. Seasonally speaking, medium and long term, after the seasonally bearish time of the year is over, we usually get very nice rallies to cap the end of the year and to begin the next year. Slap that like button right in the face if you enjoyed this video. If you watched till the end and you did not enjoy the video, I thank you for your time and attention. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next. Bye.
Oh, wow.